Today, I am going to reveal to you how I profit from the stock market, and I'm going to give you a strategy that you can do too. And it's very easy. Now, one of the things that you need to keep in mind is a famous quote from Warren Buffett. And he goes, rule number one, never lose money. Rule number two, never forget rule number one. You see, what happens when you start losing money is that it's not only bad for your trading account, but it's even worse for the morale. And that's why so many people come to this game of trading and investing. And I don't even call it a game, but in the reality, it's a game of money. They come to this game and they start losing money. They go away and they never come back. Now, the main questions are, what do I buy? And when do I buy? You want to buy quality stuff. And what do I mean by quality? A good company, a profitable company, a company with a track record. We all know good companies. We use those products on a daily basis. They ship those products to every country on this planet. We all know those companies. But is that enough to be profitable in the stock market? Don't think so. What is that has been up? What ticker has always been going up? Is that Tesla? Is that Nvidia? Is that Apple? None of the above. You can pull up a stock price chart since the inception of the index funds, and you can realize very easily that the only ticker that has always been going up is the S&P 500. I shouldn't say the only ticker. I should say what's been going up has been the S&P 500 and any variations of it. I strongly suggest you to do all of your trading and investing using index funds. Now, it might result to be boring to some of you. Some of you used to buy individual stocks. Some of you used to do a lot of buying and selling. But really, the question comes down to this. Do you want to get rich quick, or do you want to get rich for sure? Because this is not a get rich quick scheme. This video is about how to make the stock market profitable to you on a consistent basis. I'm not talking here about investing in a pink sheet and hoping that the price is going to double tomorrow, or buying a speculation at 10 a.m. and sell it at noon. This is immature hour. I've done it before. I'm guilty of it, but I learned my lesson. And what I'm going to do now is give you a game plan that you can use so that you can be successful learning from my mistakes. Like it's been said, a smart person learns from their own mistakes, but a wise person learns from the mistakes of others. So my first advice, I'm going to say this one thing again, is to stick with a broad market large blend ETF. I remember an interview with Warren Buffett. It was being interviewed by Charlie Rose. And Charlie Rose was asking Warren Buffett, what is your advice to the average investor or to a new investor? And he goes, well, I didn't change my will. Now, for those of you that don't know, many decades ago, Warren Buffett has made a will to where he was leaving the bulk of his money to his wife. And his advice to her was to put everything into a low-cost S&P 500 ETF. Now, I'm sure that a large part of his money was also being donated to charity. And I remember he wanted to make sure that all of that money was being utilized within the next 10 years from his passing. But nonetheless, his advice was to put everything into the S&P 500. Now, he also said that anyone that wants to adventure in a sector ETF, on a country ETF, and even more so on individual stocks, they're going to take a chance. And they're going to take a chance to lose money. Now, do you realize that he's the CEO of a company that invests in individual stocks? So he said that against his interest. Now think about it. There was another interview with Charlie Munger, that is Warren Buffett business partner, or I should say he was, and he gave the same advice. He said, notice, like the stock market is so similar to the biological universe, to where how many species have been on this planet? A lot. And you know what percentage of those species went extincted? Over 99%. So he was saying, look at all those companies from 20, 40, 60, 80 years ago. They all experienced a boom and a bust. Do you remember the Nifty 50? Do you remember what happened to Eastman Kodak? Remember what happened to BlackBerry, Bethlehem Steel, American Can, and the list goes on and on. So he was saying there are so many similarities. And what are your takes on this? Do you see life on this planet is going to outlast every single life species? Is there going to be life on this planet 100,000 years from now, 1,000,000 years from now, 10 million years from now? It's reasonable to assume so, but are they going to be the same species as we experience now? More than likely, no. But is there going to be life? Yes. So if you need to bet your money, would you bet it on any individual species, or would you bet it on life in general being on this planet? I would take the second option. Same thing I can talk about human race. There have been many successful people on this planet. Many people who got up to power, made a lot of money. They lead countries for the good reasons or for the bad reasons. Dictators, generals, emperors, Julius Caesar, Napoleon Bonaparte, Hitler, Genghis Khan. And where are all they now? Where are they now? Now, you could have bet on any single one of those people when they were alive. But see, you would have missed out the big picture. That everything changes and nothing is forever. So you could have bet on the existence of any of those people, or you could have bet on human race. Now, it's easy to assume that the human race on this planet is going to outlast every single human. Now, if you agree with that statement, well, then you see how the ETFs is a better, safer choice than investing in individual stocks. Picking individual stocks is like picking a species or picking an individual. But really, if you know history, you know that everything is going to end sooner or later. So you're better off on picking life or picking a human race or picking an ETF. I think it's a very reasonable analogy. Now, for this very reason, buying individual stocks, but even if you buy the best companies at this very moment, the top 10 holdings of the S&P 500, you say, look, I don't want to buy the S&P 500. It's boring. I don't want to pay the fee, even if it's close to nothing. I find it very reducing. I can make more with my money and I want to buy individual stocks. But even if you buy the top 10 holdings on there, sooner or later, you're going to find yourself with 9 stocks. Sooner or later, you're going to find yourself with 8 stocks. Anything can happen to an individual company. They can get hit by a lawsuit. Their technology can get obsolete. The CEO might retire or pass away. They can miss on revenue, and they can trigger a downward spiral. Or there can be a better way to do things, more effective. They can provide a better product. There's always going to be a new technology doing things better, faster, and providing it to the broad market for a less expensive price. This is built into technology. That's why we have all of this technology. But have you ever thought about the life of your grandparents, of your ancestors? Like it's been said that now even the poorest people now have a better lifestyle, or they have better amenities compared to what John D. Rockefeller had in 1920. So everything is going to change. Everything is going to be better. Everything is going to be faster. And everything is going to be more accessible. It's not if this is going to happen, it's when this is going to happen. So investing in a good company, individual stock, the mere fact that that company has been good does not mean that it's going to stay good forever. Actually, the opposite is true. So I hope I get my point across that if you want to be successful and you want to be profitable doing this, stick with broad market ETFs. Now I'm gonna give you some triggers that I use, but again, they're all around the S&P 500. Okay. You can buy the S&P 500 through many brokers. Of course, you have one of the most popular is provided by State Street. The ticker is SPY, and it's very liquid, and they charge you 3 basis points, close to nothing, paying 1.5% dividend. Now you can buy the same thing through Vanguard. In that case, the ticker would be VOO. You can buy the same thing through BlackRock. In that case, the ticker would be IVV. Now, there are variations of the S&P 500. There is an equal weight ETF provided by Invesco. The ticker on there is RSP. There is the S&P 500 large cap, and that is provided as well by State Street. In that case, the ticker is SPLG. If you want to buy through BlackRock, the ticker is IVW. And if you want to buy through Vanguard, it would be VUG. I hope you're taking notes, because those are the tickers that you're going to invest and trade. Now, of course, there are many more options. I would recommend it to diversify a little bit, but most of those, they pay a 1% dividend, and they charge you the same fee to own it, which is really close to nothing. Now, there is, if you want to be a little bit more focused on dividend income, there is the S&P 500 dividend appreciation, that too provided by Vanguard. The ticker is VIG, and provided by BlackRock, it would be DGRO, DGRO, dividend growth. Those are good ETFs. You might make a little bit more money on the dividend side, but you might lose it on the appreciation side. I invite you to pull up those charts and compare it. And once it's all said and done, you're better off with the S&P 500 as a overall total return of dividend plus appreciation. Now, if you want to be more focused on the dividend, there are a couple of options from the same brokers. The high yield dividend ETF, that one provided by Vanguard, is VYM. There is one provided by Schwab, SCHD. The company are a little bit different. I think SCHD have a little slight higher dividend yield, but again, those ETFs, they don't move much on the principal side. So again, you might make a little bit more money on the dividend, but again, you are going to lose on the principal. And what I mean by lose is that you are better off buying the S&P 500. So again, you want to stick around those ETFs because they are diversified. They cover a huge sector of the economy, and the companies that are included, they are from different sectors. So if the financials underperform, you have energy companies in it. Okay, if energy companies underperform, you have consumer staples in it. So you see how everything is going to balance, and you are going to mitigate your risk doing it that way. Now, of course, you can invest in the Russell 2000. There is a ticker provided by Vanguard, which is V2, VTWO. But again, you were better off buying the S&P 500. I've done all the math for you. You see, what's happening in the economy now is that seven of the top companies in the States, they are driving the economy. And those are the top seven holdings in the S&P 500. I thought Apple was as big as the next 200 or 300 companies in the S&P 500 combined. So those companies are responsible of all the gains and all the losses of the S&P 500. So that's why I want to be more focused on the large cap ETF rather than betting your money on the Russell 2000. Yeah, sure. When there is volatility in the market, smaller companies they fluctuate much more, but you are taking a chance because I think this trend of very few companies being responsible for all the gains and losses, and those companies are the largest companies. And when the market thrives, investors are going to flock around those companies. But at the same time, when there is a downturn of the market, again, people are better off keep buying the same companies. Like what happened to the tech companies during the pandemic. Actually, they experienced some gains. I don't know if you remember in 2020 during the pandemic, Tesla actually went up a lot. And now I don't know if you want to include Tesla being a tech stock, but definitely it's one of the largest companies in the S&P 500, and it's responsible for the gains of the S&P 500, being a large portion. The large cap ETF is a very good choice. You can put your money in there. Now, it does not mean that it always overperforms the S&P 500, but nonetheless, it's a very safe choice. Also, in what sector do you think the next big company is going to be? Put it down in the comments. The next multiple trillion-dollar company. Is it going to be a consumable company? Is it going to be an utility company? Is it going to be a bank? More than likely, whoever the next Apple is going to be, the next Nvidia is going to be, the next Google is going to be, it's going to be a tech company. There are tech startups. They were valued already at over 20, 40, 60 billion dollars in the IPO, and they were losing money. Startup first day trading on the stock exchange, and they already value a 60, 80 billion dollars. They are more valued than a car company like Ford. Off the bat. So it's reasonable to assume that the next big companies are going to be in the tech sector. So now the tech sector is about 25% of the ETF. Um, if you focus on the large cap ETF, I believe the technology is now about 43, 45% of the ETF. One of the tickers that is very common is SCHG, which is the large cap uh, S&P 500 ETF that's provided by Schwab. That's another good choice. Vanguard has the same large cap focus on the tech sector, and it's called VGT. That's another good choice. If you want to focus on the world market, the total stock market, inside and outside of the United States, you can buy the Vanguard uh, total stock market, and the ticker there is VTI. I think that moves pretty similar to the S&P 500 for the way that it's weighted, but nonetheless, it's a very good choice. And I'm gonna stop here with this first answer to the question what to buy. I would not adventure myself in anything which is international. I like international companies. There are some very, very good companies out there. Very good in Japan, South Korea, Europe. There are good companies, Brazil, but don't go there. There are other things that comes into play. Can be like the currency exchange, can be political tensions with other countries, like it was happening with China when they were talking about delisting some of those Chinese companies from the New York Stock Exchange, like Alibaba. There were concerns of privacy breaching issues. So for that reason, look, you can do all of your due diligence. I invite you to compare the S&P 500 with all of those indexes and let me know what you think. I've looked into it, and I feel like sticking to the S&P 500. This stock market thing is an American thing. Now, of course, every country has a stock market, and it's always going to be that way because the government profits from people buying and selling. It's a huge stream of revenue for the IRS or for any countries. The revenue that comes from people buying and selling. You buy, you sell at a profit, you're going to have to pay taxes on that. There is no way around. Everything is computerized. Your broker is going to report you and your profits to the IRS, and there is really no way around that. But because the privileged status of America, in America, we can print money as much as we can. The dollar is the reserve currency. I believe that we are very blessed. And like Warren Buffett put it, never bet against America. So I wouldn't adventure myself in any of those foreign stocks and foreign ETFs. Um, there are many of those. There is the dividend or the international or the dividend appreciation ETF. But again, I would stick with the S&P 500. It appears clear to me that is the safer choice, and it's better off for the overall total return of your money. Now, once you understood to stay away from individual stocks, what is the strategy that I use? And I've been profitable with consistency. Now, it doesn't mean that every day you are going to make money, but definitely you can look at your statement on a monthly basis or on a quarterly basis. And if you do it right, it really is easier to make money than losing them. I'm going to say this again. It's easier to make money than losing it. Okay. So now, one thing that needs to be clear is that it's easier and it is much easier to make money in the stock market if you have a large amount of money to invest. Like, do you understand that a 1% fluctuation is easily achieved? It can be achieved on a daily basis on the S&P 500. Like, I believe today is January 8th, and there was an upswing. I believe the Nasdaq was already up about 2%. So those fluctuations, they can happen on a daily basis. But even if they happen more conservatively on a weekly basis, you understand that the largest amount of money that you have, the less of a fluctuation you need. Because a 1% fluctuation, if you invest 100 million bucks, a 1% fluctuation, it's already putting you $1 million in your pocket. Now, of course, you're going to have to pay capital gains on it, but you get the point. So the largest amount of money that you have to invest, the easier it is. We are competing here, we as individual investors are competing here with the large corporations that have a lot of money under management, a lot. And what happens if you only have $5,000 to invest, or 10 grand? It's a dangerous situation to be in. And here's why. Because a small fluctuation is not going to give you enough profit. And you're not going to sell because you want to wait a little bit longer that you make more money. And guess what happens? The following day, you've lost 10, 5%. You might not ever make it back. And this happens because with a small amount of money, you go invest 5,000. You are hoping to make 10% on that individual stock. And it's just not going to happen in the short term. It's not going to happen because you are competing with larger corporations that by the time that you buy and sell at a profit that makes sense to you, the fast money is already gone a long time ago. Because they can sell at a split of a percentage gain and make much more. It's for that reason that all of those investors that come to this game with 2, 5, 10, 20 grand, it's not much. Anybody that tells you that you can start with 5 grand, yeah, you can start, you can do whatever you want, but this is not the purpose of this video. I'm addressing to people that have more money to invest, and they can put that money in a rotation. Now, here's it's how it's done. You understand now that you gotta buy broad market ETFs in America. You put it in a rotation. Now, what does it mean? Let's say that you have $1 million. That nowadays $1 million is not very much. Everyone has got $1 million possibly in the equity of their house, equity in their business, investment, 401k. Yeah, I don't think $1 million nowadays is what it used to be. But let's say that you have $1 million for the simplicity of the math. How do you go about? It would be smart. You take that $1 million and let's say you divided it by 20. It can be a different number, but let's say 20. Now that's going to give you 50 grand worth with an individual lot. You got $1 million divided by 20, it gives you 50 grand. Now, what do you do with that 50 grand? Let's say that you put it into the S&P 500. You put it, you buy it. And you don't have to buy every day. You can buy whenever you feel like, or it depends on your income situation. You profit from your clients are paying you on a monthly basis, or your company is paying you every other week. I don't know, you got dividend stocks that pay you on a quarterly basis. I don't know your income or your financial situation, but let's say that you buy with consistency. It can be every day, it can be every week, it can be every other week or every month, but it's important that you buy with consistency. Now you put that 50 grand into the S&P 500. Now what happens in the next day, the next week? The market can go up or down. Now, if it goes up, you sell that position. If that's what you do, if that's what you want to do, you can sell your position. If you set up to make 2% on that position, now 2% is not a huge fluctuation, it's easily achieved. And 2% on 50 grand is gonna put on your pocket a grand. Now that can be achieved on a daily basis, or every other day, or twice a week. Now that's already gonna put you 2 grand in your pocket that week. So you might even buy a 50 grand position in the S&P 500. You can start today, or you can start whenever you're ready, or you can start when the opportunity presents itself. But really, there are not opportunities. You might want to be invested as much as you can. And so the way to do this, because no one has the crystal ball, the way to do this is to buy with consistency or dollar cost average into the market. So now, once you bought the 50 grand into the S&P 500, you might at the same time place a sell order to sell it at 51 grand. Whenever you are profiting a grand, you can buy, place the sell order, and even forget about it. You know that when it's gonna hit, you're gonna get notified and you've profited $1,000. Now, what do you do if the following day or the following week the market has gone down? Don't panic. You use the second lot of the 50 grand and you can buy the S&P 500 again. Maybe you can buy from a different broker this time, or you can buy the large cap S&P 500 this time. You bought it this now the second time, you place another sell order when it hits a 51 grand. That's it. You don't have to do anything. Now you wait another week. The market, let's even say that it's been going down. You use your third lot of money. You put it into the another. You might want to put it this time into the dividend appreciation S&P 500. Now, what's going to happen the fourth time? The market might even be down again. In that case, you're going to buy again. And let's say that you buy into the S&P equal weight ETF. But there is nothing wrong if you buy the same position again and again. But again, it's going to have to be an ETF built around the S&P global market, a large blend. I'm not talking here about a sector. I'm not talking here about a country. I'm not talking here even more so about individual stocks. Stick to those few tickers. And it repeats. The following week, the following month, whenever you're ready, you do the same. You take the next lot and you allocate into one of those, and you place a sell order as you please. So now, as the market goes up, you profit a grand every time that you sell. If a market goes down, you buy. You see, I'm positive of this because the S&P 500 is going to go up. Now, can it go down in the short term? Yes. But it's pretty reasonable to assume that the S&P 500 is going to go up. Now, there was a time that Apple was not even $1 trillion. And then it went to be $1 trillion to $2 trillion market cap. And everyone was very surprised. Oh, the first company in history to hit the trillion back milestone, the 2 trillion. What do you think is going to happen in the future? It's going to go up again. But what do you think it's going to be in the future? The next company, the next Apple, the next Microsoft. And they're going to be valued 5 trillion, 10 trillion. It's going to go up. It's built into this money process. It's built into inflation. It's built into everything now is an IOU. Every single dollar bill that's being printed, it's an IOU. And asset prices are going to go up. Now, I'm not saying that the price of Apple is going to go up, but whoever the next company is going to be, whoever the next Google is going to be, it's going to be valued 5, 10, 15 years from now to much more than what it is valued now. It has to be this way. There is no way around. It's built into the money system that the S&P 500, it'll have to go up. So your odds of gaining is in your favor. This is the opposite of what happens in a casino. In a casino, the opposite are against you, no matter what. Every hand that you play is against you. But here, if you can play with consistency, if you can play smart, if you don't let your emotions run you, it's been said that you either control your emotions or your emotions control you. If you don't panic sell, and if you do it with consistency, the odds are in your favor. So again, you put this amount of money in a rotation, you buy as the market goes down, you buy with consistency, you buy a position and you place a sell order. The following time, you buy a position, you place a sell order. And you do this with the S&P 500 and any variations of it. Doing it that way, you are going to profit with consistency. Now, does it mean that you are going to beat the market? No, because it could be very well that you were better off putting everything, the initial $1,000,000 that you had, into the S&P 500 that day, and forget about it. And there is a chance that you were better off doing it that way, but because nobody has the crystal ball, I am pretty confident to assume that those index funds can fluctuate 2% on a weekly basis, that the S&P 500 is always going to go up, and I've got 200 years of history to prove that. So it's a game of possibilities, and what is reasonable to assume that there is always going to be small fluctuations in the S&P 500, and that in the long term it will go up. So if you can do this, you can make it profitable to you on a weekly basis. Now, in this example, now I'm using the $1,000,000 portfolio. You can do it with a smaller amount of money, but again, you are not going to profit as much, and you're going to be willing to sell those companies. The 1% is not going to add up to much. So the largest amount of money that you have, the easier it is, the lesser of a fluctuation you need. It's more likely that there are small fluctuations in the market than a large fluctuation. So I hope this video has been helpful. I hope you're going to implement this methodology. And I also believe that this is the best thing you can do to mitigate your risk. So let me know what you think in your comments. I've already bought my share of the S&P 500 large cap today. I hope you're going to do the same tomorrow. And I wish you happy investing.